Welcome back, everyone, to another episode of Ready, Aim, Retire, the show where we talk all about retirement, about building your nest egg, distributing your nest egg, and let's not forget the legacy for the kids and more importantly, I think the grandkids. So I'm Rob Kirvan, your host as usual, here with Tony Shore. Tony, how are we doing today?
I'm doing great. I've had a great week. Yeah, I'm just excited to be here because we have an amazing special guest today. I mean,
another big get.
A guest that, honestly, busy guy. I mean, you see him on all the major networks as a talking head, as a guest there, Fox Business, CNBC, the senior portfolio manager of Gradient Investments, Keith Gangl, is here.
Yes. Welcome, Keith. Welcome, Keith.
Love the introduction. That's fantastic. It's great to be here with you guys.
Keith, I know you've been on the show before, and maybe you've noticed what I've noticed already on the show. For those that aren't watching or just doing podcasts, you might want to tune into this. Tony's wearing a suit jacket today. Like just out of the blue, Tony shows up in a blazer. I've never seen that before. Like he's always dressed good. We know that, but the blazer, you know, I figured he was going for a job interview after this. I wasn't sure.
He might be. He is looking sharp, isn't he?
Oh my gosh, you guys!
He's like Don Johnson. He's got like the black T-shirt underneath. He's just ready to rock and roll. Like.
Yep. Minnesota Vice.
Yeah,
Minnesota Vice. It's a new series that I'm auditioning for.
2025 version.
Be the lead detective.
Yeah, you can pull that off. Yeah. You can pull that off. So let's get to Keith. So you did a nice little build up. Let me just add to the build up, Tony. If I can. So he's senior portfolio manager, obviously with Gradient Investments, one of our partners. He has been in things like Investors Business Daily, Bloomberg, Reuters, other publications. You already mentioned CNBC. He's a contributor there from time to time. So if you turn your TV on, you may see Keith Gangl there, spouting his words of wisdom. Here's a bigger one though that people don't realize, and Keith hates when I say this. I said this last show, and I'll say this every time he's on. Is he was the 2-time winner of the Lipper Leader Award, and that's given to the fund that excels in providing consistent, strong, risk-adjusted performance relative to their peers. And their peers, Tony, in this case, is everybody in the country, throughout the U.S. Insane. So that's everybody. So you guys listening out there, and you're in funds, and you're doing this, and there's clients listening, and we have a huge following of people that just want to get good financial information. Keith beat them all, not once. He beat them all twice, which is pretty incredible. So again, it's a big get. We're happy to have you here, Keith. Keith is also an avid lake guy. Just give you personal things. I've seen video of him putting like pontoons in, nobody helping. Similar to around my house. Doing the pool, nobody helping out at all. Keith does it all. So when he's not, analyzing stocks, he does have a pretty good social life, or a pretty good family life, I would say.
Yeah, you and I are pretty similar. I got a couple girls. You got 3. I got 2 and a son. It seems like when work is, it's like they seem to all just disappear. I don't know what the problem with that is.
Yeah, no, like when they were younger, I could make them shovel the snow.
Yeah,
pull the weeds. As they got older, they realized, like, what could I really do? I can act, right? But it's not like, this isn't the 50s. I can't just like beat them into submission to get out there. It's just like,
this isn't the 50s.
They know that that's not an option. So it's just like, what are you really going to do? I'll be chilling in my bedroom if you need me when you're done, kind of thing. So,
yeah. Or on the golf course, maybe.
On the golf course. Yeah. They could be on one of them could be on the golf course for sure. So Keith, what do you got planned for the summer? Were you doing any fun things?
Fun things, like I said, talking about kids, I just had one graduate from high school, my last one, so he's the youngest, and the 2 girls are home from college, so a lot of family time, a little time on the lake will be nice, a little vacation here or there, going to Canada next week with the work crew, which will be good.
Yeah, that's going to be a great one. Quebec City, right? Like, that's gonna be
Quebec. I've never been there, so
it's a good spot. You'll
back to your old lands a little bit.
I am originally from Canada, not that side, but
I had to get a map out and see exactly where that was.
That's far east, baby.
Yeah, far east. Wow.
Yeah.
Almost to France, right?
Yeah.
Almost to France.
That's why they speak French there, huh?
Yeah. They do speak French, so hopefully you're popping up on that.
Yeah, 1 year in high school. I think that's dating myself. That's a long time ago. 30.
I had to take a 1 year in high school too. Like where I grew up, all you had to do was pass French once, and then you didn't have to ever take it again. So I passed it in like freshman year, and
Yeah.
that's all I know. Everyone's like, "Oh, you must speak fluent French." I'm like, "No." There's only a little tiny section of Canada.
Yeah, and that's Quebec.
That's Quebec.
Yeah,
Like no one else speaks.
Didn't
French.
they even try to secede from Canada or propose
Yeah,
it?
yeah.
Haven't they lobbied
Really?
for that a couple times?
Like
Yeah.
ever since I was a kid, they've been trying to leave Canada. It's like, where are you going
They
to go?
want to be part of France. They asked France to take them as make them part of France. They want to be French, and it's so fun. It's so odd to me.
Well, maybe Trump will take him. You know, he seems.
Yeah, he might. You know, if they're
he wants another part of the
51st state thing, he may just
not all of Canada. We're getting Quebec, I guess.
We'll just grab a little piece. You never know with those guys. So Keith, let's talk first before we have a few good things to talk about today. Let's talk first about the markets. The markets have been kind of roller coastery. Like it's, you know, like you were on the show when the tariffs thing actually first kind of broke.
Yeah.
And you spoke to that a little bit. What have you seen? Like, you know, obviously we're almost through the first half of the year, and then tell us about what you think for the second half.
Yeah, first half of the year, you know, if you didn't tuned out the media or even to stop watching the market for the first 6 months here, and you see the year to date S&P 500 is up about 3%. You're like, oh, kind of a normalized year. First half 3%, get another 3-4% in the back half of the year, and that's kind of a normalized year. But certainly hasn't been the case. It's been a very volatile year. We started out the year slightly positive. All of a sudden, you just touched on it, Liberation Day or, you know, April 2nd, liberation from our wallets or the stock market, it seemed like for a little while there.
April was rough.
We were down, like, again, going into April, we were up slightly. What I mean up is the S&P 500 was slightly up. The market sold off almost 20% from the highs. So we got in correction territory, which is down 10%. We did not hit officially bear market, would have been down 20%. We got close. It was
close. It was 19.
I think it was 19 something.
Yeah.
So, but then I think everybody started to kind of realize these tariffs, and that's kind of our position. It's been more art of the deal. We think there'll be some walking back. You've seen that. You saw one day, all of a sudden Trump came out with we're going to delay the tariffs for 90 days. Markets are up 12%. So fast forward to the volatility. So that's why, you know, clients are working with you. You do a fantastic job with them. Kind of stay to your plan. Don't panic when that 15% downdraft on Liberation Day. We don't know what's going to exactly happen, but fundamentals in the overall economy are still very positive. And you do a great job with your clients saying, stick to your plan. We don't know when it's going to turn or how quickly it has, but also you get a 20% bounce. So if you would have panicked on the bottom, you would have missed that 20%. Then you'd have been like, now what do I do? You know, the markets are up 3%. I think fundamentals are still in place. Your second question was, what do you think for the back half of the year?
Mm-hmm.
You know, going into this year, I thought we'd have a normalized year, which that's 7 to 10%. Currently, you know, again, we're up 3%. We have 7 months left. Wouldn't surprise me. We kind of grind higher and finish, you know, that 8 to 10. So slightly positive from here, but it won't be a straight line, right? Us as investment professionals would love if the markets just kind of went, you know, linearly up every month, you know, say 10%, we almost get 1% a month. Wouldn't that be fantastic? Wouldn't have to worry about it. Wouldn't have any angry clients. But I think so the back half of the year, unemployment's still at 4.2%. Earnings are strong at around 9% forecasted for the end of the year. Ultimately, I think that's what drives the stock market. Now, again, there's some tariff news that could come out today or tomorrow or the next day that could change our opinion or at least kind of shock the market. Or the other thing that we're kind of watching is this big, beautiful bill work its way through Congress. And we'll see if that kind of scares anybody or not. But I think most people are, you know, of the mindset that we want to, well, the biggest thing that I want to see is our taxes not go up. Kind of, you know, if nothing happens with this bill, at the end of this year, taxes are going up. That could be a headwind for the overall market. I don't see that. I think there'll be some kind of agreement, you know, puts and takes some other stuff. So that being said, you put that all together, I think we get that normalized year. But I wouldn't be surprised if we see another 5-10% pullback and then reaccelerate as well.
Right. And I think like you just said, we're one tweet away from the market going this way or the market going this way.
Right.
And it's kind of crazy. It's harder to manage through when you have that political headwind. And that's going to be there. The tariff story, like you kind of alluded to, is going to come and go. Like eventually the tariff story, no one's going to talk about it. It's going to be over, whether that's a month, whether that's 3 months, however that shapes up. But then there's going to be something else. Like we just kind of know,
always,
we did this, in the last term, and it's always something, and there's always kind of angst in the air, but at the end of the day, if companies make money, their stock goes up. and these little, bumps in the road along the way will continue to happen. And I anticipate that for the next 4 years, that these will continue to happen. And we'll have some panic here and there. I don't know what the next part of the agenda is, but you got to think, if that bill comes through, if the taxes remain the same or even slightly lower, and there's a few things in there that are probably helpful to the, to the overall economy, that's got to be a tailwind, right, Keith?
Yeah, that's for sure a tailwind. That's why I like to see it get done. But that's kind of the wild card. If something happens there that it doesn't go through, I think that would be certainly a headwind for the overall markets. But generally, I think the consensus is it's going through, and I certainly think it's going through in kind of there'll be some tweaks to what it is. But I think the main thing I'm going to be focusing on, just like you said, are taxes. If the taxes kind of stay the same or even get lowered a little bit on certain parts of it, I think that's a tailwind. No one spends more money than the U.S. consumer. We talked about it earlier, our kids and stuff like that, and
sure,
ourselves included, right? We love to spend, and if people are working, again, unemployment at 4.2%, they have money in their pocket, and no one can outspend the U.S. consumer. It's a good backdrop.
Right, for sure, and really, we've talked about recessions and things like that, and people really talked about recession in April, obviously. And usually when you see events like that, the market doesn't go down 20% unless people are selling. So we're panicking instead of just taking a step back and letting things play out a little bit. Like doing that initial panic at the moment in time it's to me, it's insanity. It just makes zero sense. You have to let things play out. See, kind of see what happens. Whether you agree with it, disagree with it, it doesn't matter. And stocks don't really know what you agree and disagree with. So let things play out. Don't panic. And if you didn't panic, like Keith just said, the market's up almost 3% year to date. So
yeah,
you went up, you went down, and it's been an 8-week fight back. Of just a massive grind of just taking little victories kind of along the way, and that's been positive. So it's been pretty good for those patient investors with a plan, with a purpose. Tony, shameless book plug. But it is, if you have a long-term plan, these little short-term things shouldn't affect you. You should be worried about where you're planning your next trip, what the kids are doing, what you're doing in the summertime. That's what you should worry about. Let us worry about the other stuff. We are always on conversations, always talking to guys like Keith and his staff, and looking at different things that we can invest in, which is just a beautiful segue for what I want to talk about today, Keith. So here's my issue, and I think you have a solution. So we have several clients with either trust, like investment accounts, either trusts, individual, or joint accounts. And what happens in these accounts is a lot of times they're not using the money. They're kind of earmarked almost for legacy, or something happens down the road, we're going to use this money. But for a lot of times, they're never taking a withdrawal from it. They're never taking money out. But what happens is because of trading, what ends up happening in any given year, most years, except for probably a down year, but even down years, this can happen, is you get these realized gains. So you're paying taxes on this account that you're not touching the money, almost like a CD. Like someone buys a CD, it goes around the horn, and you pay taxes on this money that's locked up that you're not using, right? So that's been a challenge for years, and I believe you may have a solution. So tell us what a solution that I'm not going to be paying taxes, but my account's still going to appreciate. I'm still going to have it growing. I'm still going to, obviously, depending on my risk, get to where I need to be, but I'm not going to be paying heavy taxes every single year on money I'm not using.
Yeah, at the beginning of this year, we actually rolled out a new solution or set of portfolios called the tax advantage portfolio. Basically, what other portfolios, like you mentioned, we, as a manager of several other portfolios, we basically trade on our best idea, not concerned about whether it's short-term gain or long-term gain and those things but now to your point, we want to focus on a portfolio that focuses on after-tax returns. And so that's why the tax advantage portfolio we introduced. We have 4 different models. We have a growth model, which would be all 100% stocks, which we use ETFs for. We have a moderate growth, which is going to be 75% stocks, 25% bonds, a balance 50-50, and then a conservative, which is 75% bonds. And those bonds that we're using ETFs as well there. But we're going to look at investing in munis, right? So then at least on the national basis, you're going to have that, it'll be tax-free, right? And then you're still going to get hit with your state taxes, but that's just a small piece compared to the overall federal number as well. So that's the solution we have. And the nice thing about it, we do 2 different things. So we want to focus on the tax man's always going to get his money. It's just a matter of when he gets his money. And to your point is, if you don't trade something, you don't have to pay taxes on it. So within these portfolios, we're going to focus on long-term gains. So we set up these models at first, and these are, things that we're actively going to watch it, but we're not going to be day trading by any means, or even trading very often in it. If there's a big opportunity, we may make a trade. So then you could have some tax consequences. But for the most part, we're going to wait for a year plus when you get shift into that long-term gain versus a short-term gain, right? There's a huge difference between your taxes at long-term gain versus short-term gain. So that's one of the ways we're going to manage it. The other thing we're going to do is tax loss harvesting. Tax loss harvesting is fantastic. And actually, the timing of when we roll this portfolio has been really good, right? Because if we go back how we talked about the market this year, beginning of the market, we're up about 4%. And so if people are in this portfolio, up 4% roughly, all of a sudden the market sell off pretty aggressively. It's like, okay, well, market's selling off. What do? Our positions are going down with the market as well. We sell those as loss so they can bank those losses that they can use to offset some gains in the future. So every week we go through every client's portfolio and say, okay, do they have roughly around a 5% loss in this position? If they do, we'll sell it and buy a similar position to kind of keep the same kind of risk and consistency going forward. But now they're banking these losses. And what the nice surprise about this V-shaped recovery is the fact they were banking a lot of losses in that down 20%, right? There's several weeks it's like, oh, there's another 5%. There's another 5%, which we don't really want to do. But then also the market rallies and you have all these losses banked. You have the same kind of risk profile and the kind of returns. And oh, by the way, you're up 3-4%, but now you have all these losses banked as well. When we do take some gains, or you have gains outside your other investments, you can use those to offset them. So that's been a fantastic solution. The timing's just been really good this year.
And really, in a given year, Keith, you're going to see minimum, at least 5+% pullbacks, right? In any given year. So that would be the time where you guys would look at that and say, listen, let's start banking some losses. So even if my account ended up plus 15%, I may actually have, thousands of dollars in losses that I'm going to be able to use or carry forward or use against my taxes or however that looks, right?
Yeah, exactly. You nailed it. And then on top of that, the other thing we did was on the pullback, we actually changed it. One of the positions was we were more looking at some of the small cap stuff. We reallocated that to looking at large cap technology, and those have had a fantastic run off the bottom. So not only do we capture those losses, those small caps, we rotated to something that was actually better as well. So now going forward, that's what we're going to look at. And again, we're going to try and stay focused on, we're going to look at long-term gains versus short-term gains. So, if things are up, we're generally going to hold them so you don't get that kind of surprise tax, bill come end of the year.
Right. And for people listening out there that have these type of accounts that are paying the phantom income, you want to take a look at this, give us a call, and I've had several conversations with you, Keith, over the past 6 months about this. We have not invested any money into it currently because we were waiting for that first half year, to kind of see how does look, how the losses look, and everything that I've seen has looked fantastic. It's looked really good. But give us a call at 630-780-1099. We can review what you're currently doing. If you're a client of ours, I've spoken to several clients about this portfolio because let's face it, last year, big year, a lot of them paid a lot of tax, and more than normal, and just because of active portfolio management, like you just said, this one's gone up this much, we got to buy something else to replace it, and so your people are happy their accounts are up, Keith. Don't get me wrong. No, you're in a better position if you're making money. There's no doubt. If you're paying taxes, folks, you're making money. That's important. But I did hear a lot of it. We've spoken to several clients of like, hey, once this thing hits the 6-month mark, we're going to do a full analysis, and then we're probably going to start rolling into this, to help people out, because I think it's fantastic because it accomplishes what they're trying to do. They're trying to either leave this money for legacy, use it down the road, but not pay the taxes. And if you're paying short-term gains, tax at your ordinary income, you could be paying 20, 24%, depending on kind of where you're at. Whereas long-term gain, you're only at 15%. So even when you're pulling the money, you're going to be pulling at a better rate, right?
Yeah, and you summed it up well, and that's the difference of this. Other portfolios, we're looking for opportunities. Like I said, if the valuation seems to get stretched, we'll sell it and look for a different opportunity. This is going to be certainly a lot more of a buy and hold, especially for people with non-qualified legacy money that at the end of the day they're concerned about the taxes that are due every year, and this portfolio is going to try to minimize that. At the end, if at some point in time you decide to sell out of all these portfolios, there is obviously a tax bill, right? That's
Sure.
a whole transaction.
Right.
But if we can delay that and farther to the right, maybe when your tax bracket goes down or something else happens, I think that's a good situation. And it's certainly something that's another thing that a lot of investors should look at, all these different buckets that we have, and talk about diversification, stick to your plan. So anybody that's got legacy money that's non-qualified, I think this is certainly a good solution for them.
Yeah, I would agree. And when someone passes down the road, all of those gains that are currently in there, they all step up in value. So you actually pay no tax on it. So if you're able to harvest these losses along the way, and if it is legacy money and you pass them, you're going to pay no taxes on it. So instead of doing it the current way where you're paying the toll every single year for money you're not using, instead of paying the taxes and paying the tolls all the way along the way, what happens in this case is you actually get to realize some losses, which could help your other tax situation out. And for legacy money down the road, when you pass, they actually pay zero tax on it. So it's like a win-win. You're winning the short term when you're paying the taxes. And let's face it, people when they're retired, especially if they're later on, they're not spending that much money. So they're not pulling any money out of these accounts other than maybe required distributions. But a lot of times those required distributions, where they go? Into the trust account. Yeah. Because it's not using it. So, all of a sudden they have to pull money out to pay taxes. And that's not a great solution. Like even though their account's up, a tremendous amount of money, they're paying all these taxes, So I think this thing that you guys came up with Keith, not that you came up with it. I know it's been around, but this portfolio though is a fantastic solution for people like this, right?
Yeah, it is. It's a great solution, especially like I said, again, for people that have legacy non-qualified that want lower turnover. It's kind of, we construct it to look a lot like the overall markets, right? We have several different ETFs within it, but it's just, we're going to be actively monitoring it, but we're not actively trading it. And when we see some opportunities, like I mentioned, we sold out our small cap position when it was at a loss, and then we bought something that performed, similar to slightly better so far. And again, that's kind of going to be the strategy with this portfolio. If we see a big opportunity, we'll make a trade within it. But generally speaking, we want to wait to a year, because then it's a huge delta when you're going that, from long-term to short-term gains, and at 15% versus 24 plus % some people are in that tax bracket. So that's a big savings. And it's like you said, no one wants to get hit with taxes, and everybody, when you come to year end and all of a sudden you're doing your taxes or having your tax man do it, and all of a sudden you see these big bills because of unexpected. Again, it's a good thing that you're paying tax. That means you've had gains, but it's still an unpleasant situation. So we'd like to dial that back.
And what's that fund called? What's that portfolio?
Tax advantage portfolio.
The tax advantage portfolio.
The gradient tax advantage portfolio. Yep.
Yeah, gradient investments. Well, that sounds like a great solution. And I think it's great you brought this topic up, Rob, because it really is an issue. And it's frustrating to see. I know it's frustrating to see these gains and have to pay taxes on them, and you're not utilizing that money.
No. It's literally, it's one of those things. It's like a CD, same sort of thing, where you get the CD, you don't touch it, and you pay taxes on it every year. And not that there's always a solution, but right now we do have a solution.
Sure.
So I think this is a fantastic solution. Like I said, I've spoken to several, and we'll continue speaking to several clients that this would be appropriate for. And again, like Keith said, this comes in every risk level. So it's not just, okay, it's in the market. It's conservative. Yeah. It's balanced. It's moderate. It's growth. And people fall into all those categories. So depending on where you're at, you don't want to pay taxes no matter if you're conservative or growth, and people are still paying them, So this is a great solution for that.
Yeah.
That's awesome.
Well, I don't know, Keith, I wanted to bring you on, and I appreciate you coming on to talk about that. That was my main thing. I know we talked a little bit about the markets and stuff, but I wanted people to really hear about this tax advantage strategy, because I just think it's one that's going to be utilized by us for sure, over the coming years, and I think clients will benefit hugely from it. So we appreciate you coming on, I know you had, Keith. I talked to Keith yesterday. He had something else going on. I begged him. I promised him things I can't even deliver on. And, and here he is. So
you're our number one guy.
That.
How couldn't I? Right. Like Rob asked for stuff. We move things.
Yeah. How high do I jump? Right. Yeah. No, but I appreciate it. I know you're busy, so I definitely appreciate it. And Tony, gosh, coming in hot with the suit.
Yeah. The
wow.
Coat.
Yeah.
Just trying to make an impression.
Good. So good.
I'm bucking for a raise. I'll be hitting you up for a raise, Rob.
Oh boy.
That's no problem.
That's okay. This is like a job interview. I got oh boy. It's like an annual review.
Yeah. Well, anytime you throw out the words tax and advantaged, it's a great show for our listeners out there. People pay attention to this because we all want to minimize that tax burden or, use strategies to deal with this. And I'm glad we talked about that. The tax advantage portfolio. That sounds great. Now, before we go, Rob, if our listeners out there have questions, even if they have questions for Keith, you have Keith on speed dial, apparently. So the senior portfolio manager from Gradient Investments, how can our listeners set up that no charge, no obligation consultation, or just get a hold of you and your team there at Advanced Planning to talk about this?
Yeah. And people out there, like you're probably, a lot of people listening are probably have some sort of exposure to this situation, depending on kind of where you're at. So definitely give us a call, 630-780-1099. That's 630-780-1099, or go right to our website at apadvisorsgroup.com, apadvisorsgroup.com. Go through there. Lots of information. Actually, Tony, a lot of old shows that we've done are on there. And I would tell people out there, subscribe to this channel. Cost you nothing, but you get, when the new show comes out, you get a link right to it. So be aware. You spend 20-25 minutes with us every week, and I think the variety of shows you get a different. Can I speak, Tony? Jeez, you get an outlook. I don't know what's happening, folks, but you get an outlook of several topics that definitely have to do with retirement. Will definitely help you, shore things up a little bit, whether you're a client or not. Definitely, subscribe to that and then send it to your friends and family, neighbors, people in the office, people on the streets, at the coffee shop. Just shoot it over to them. It'd be fantastic. But we do appreciate everybody listening, and definitely go to those, our phone number or our website and book in. Come on in, sit with me for half hour, 45 minutes, and then we can see if we can help you with your situation.
Sounds good. And for our listeners, once again, 630-780-1099 is the phone number, or go to apadvisorsgroup.com. Great show today. Thank you, Keith Gangl. Thank you to our host, Rob Kirvan. And that does it for today's episode of Ready, Aim, Retire.